Imagine this. You're 35 years old, earning a stable salary, paying the bills on time, driving a decent car, and doing what everyone says is smart, saving. Every month, $200 goes straight into your savings account. You've been doing it for years. After a while, you open your banking app and feel proud. 15,000 sitting there, solid, safe, responsible. Then you notice something. That balance hasn't really changed much. Not because you stopped saving, but because your interest rate is microscopic, 0.6%. All that discipline, and your money earned you just $90 the entire year. $90. Meanwhile, prices keep rising. Groceries, gas, rent, everything costs more. You start to wonder if playing it safe is actually making you fall behind. This is where a quiet truth hides in plain sight. Saving protects you, but it doesn't grow you. You see, saving money and building wealth are two different games entirely. They both matter, but they play different positions on your financial team. Saving is defense. It keeps you from losing. Investing is offense. It moves you forward. If you only play defense, you survive, but you never win. Picture two paths. On the first path, you keep $15,000 locked in your savings account, earning 1% a year. After 15 years, that becomes roughly $17,000. Not terrible, but barely noticeable. On the second path, you take that same $15,000 and invest it in a simple fund that earns 9% annually on average. Now, 15 years later, you're sitting closer to $56,000. Same effort, different approach, and the result isn't just more money, it's more possibility. That gap between $17,000 and $56,000 isn't luck, it's time, patience, and compounding. It's your money working instead of waiting. So why doesn't everyone just invest? Because the psychology of money is rarely logical. People don't avoid investing because it's hard. They avoid it because it's uncomfortable. Savings feels safe. You can see it, touch it, feel in control. Investing feels volatile. It moves, it dips, it climbs. And uncertainty feels like danger, even when it's actually growth in disguise. That's why the shift from saving to investing can't be impulsive. It must be strategic. Step 1. Build a real safety net. Before talking about stocks or funds, make sure you have 4 to 8 months of expenses in cash. If you spend $4,000 a month, keep about $20,000 to $30,000 readily available. This is your peace of mind money. Not for vacations, not for investments, but for life surprises. Step 2. Once that's built, divide your money into 2 groups, stability and growth. Stability money sits still. Growth money moves. If the market dips, your stability is untouched, and that calm gives you the courage to let your investments breathe. Step 3. Start small. Investing isn't about hitting home runs, it's about showing up to every inning. You can start with $50, you can start with $10. The amount matters less than the consistency, because once the habit forms, percentages take over the heavy lifting. Step 4. Avoid complexity. You don't need crypto, options, or fads. The most powerful tools are often the quietest. Low-cost index funds, or ETFs. They spread your risk across hundreds of companies, so your future doesn't depend on anyone's luck. Now let's look at an example. Let's say you start contributing $500 a month into a diversified index fund that grows, on average, about 8.5%. After 25 years, you'd be sitting near $500,000. Your total deposits? Just about $150,000. The rest, more than $300,000, comes from compounding alone. That's not a promise, that's math multiplied by time. Compounding doesn't demand brilliance, it demands patience. Every day your money stays invested, it learns to make more of itself. Pull it out too soon, and it forgets the lesson. But maybe you're still thinking, what if I invest and the market crashes? Fair question, and it will crash many times. But history has shown us something powerful every single time. It always recovers, and it always climbs higher eventually. Downturns aren't disasters for long-term thinkers. They're discounts. Each dip is like buying shares on sale. Here's the funny part. Most of the people who panic and sell low, They're the ones without a solid emergency fund because they need money right now. Liquidity forces emotion. Preparation creates patience. And that's why your first investment in wealth isn't into stocks, it's into self-control. Now, let's talk a bit deeper about the long play. Imagine you start at age 35. You invest consistently, month after month, for 20 years at a modest return of 8%. Then you stop contributing completely. From age 55 to 65, your account just grows untouched. By retirement, that investment has quietly doubled again. You didn't even work for it. Your earlier discipline did. That's the true power of time. Money doesn't judge effort. It amplifies duration. Here's the trap, though. Many people never see those results because they interrupt the process. They get scared, pull out their money, wait until things stabilize, and miss the rebound entirely. They chase safety until safety costs them decades of growth. Meanwhile, inflation never takes a day off. At 3% inflation, prices double roughly every 23 years. That means the $15,000 sitting in your account today will only buy what $7,500 buys 3 decades from now. Standing still financially is the same as walking backwards slowly. To protect yourself, you have to grow at a pace that beats inflation. That's the true job of investing, not to get rich quick, but to stay rich naturally. Some people think investing is gambling. It's not. Gambling is guessing. Investing is letting time and math win small, steady victories over and over again. There will always be noise, headlines predicting doom, markets swinging wildly. Ignore the noise. Listen to the data of decades, not days. If you stay consistent, discipline becomes wealth's best friend. Eventually, something changes inside you. You go from fearing the market's movement to appreciating it, because you understand that motion equals life, both for people and for portfolios. Years later, you'll open your investment account the way you used to open your savings app, but this time the number won't creep, it'll climb. Not by luck, not by miracles, by design. And that's when you'll realize what the financially free already know. Saving builds foundation, investing builds freedom. Both matter, but one runs your future while the other just stores your past. So the path is simple, not easy, but simple. Protect first, grow second, wait longest. Every dollar sitting idle today has a job waiting, and every day you delay hiring that dollar, inflation quietly steals its paycheck. You don't change your life by saving harder, you change it by teaching your money how to multiply itself. If this message flipped a switch for you, take it as a sign. Invest something, anything, today, because compounding doesn't judge the amount, only the start date. The earlier you begin, the louder the future thanks you, because one small decision, repeated long enough, replaces financial stress with freedom. Start small, stay patient, and watch what happens when your savings stop sitting still and start to grow. This is NetPlus, where money stops being a mystery and becomes a language you finally understand. Hit subscribe for more deep dive lessons that actually stick.